Welcome back. Welcome back. I know it's been a few weeks. I apologize. I've had some crazy things going on in life, as I'm sure all of us have. But thanks for coming back to Midwest Sagacity. I'm Midwest Savage. And when I first started this channel, I wanted to start asking questions in a way that gets you to start answering them or thinking about what those answers might be. And I wanted to take that and keep on zooming in closer and closer and closer, all the way to the level of this, the programming, everything that makes up the world that we believe in, what we see, the programming that is put in front of our face to make us think a certain way, see the world a certain way, when all it is underneath is this. It's a little more complicated than that, but your brain is a biological computer. And there are powers that want to try to take over that computer. There is some control trying to be had. And one of the biggest things they could do to start rolling that out is happening right now. Let's get into it.
At least 6 shots from inside the building.
I mean, what do we got to do?
Parties are running out.
What is it that we can say to get people to wake up?
I'd like to begin today by updating you on our efforts to recover the debris. China has a high-altitude balloon program for intelligence control. The president also instructed the intelligence community to take a broad look at the phenomenon of unidentified aerial objects.
FEMA is now sending a team to East Palestine, Ohio, and this comes more than 2 weeks after the train derailment threatened.
That reminds me of stuff that just happens at work. Just one person after another not doing their damn job, and everything would be okay if everyone just did their damn job. All right, guys, the issue that I want to get into today is going to be the central banks. Some of you may have heard this, some of you may have not, but the Fed just released a bombshell on March 15th, and we're going to go over that today. However, before we do, we got to go all the way back to the beginning of this country and one of the main reasons why we are America and we're under our own rule. So let's go ahead and slide over here. All right, let's go ahead and take a look at the history of central banks in America. And we're going to go ahead and go over to this Wikipedia article so you don't think I'm making anything up here. 1781 to 1836, the Bank of North America and First and Second Bank of the United States. Some of the founding fathers were strongly opposed to the formation of national banking system. The fact that England tried to place the colonies under monetary control of the Bank of England was seen by many as the last straw of oppression, which led directly to the American Revolutionary War. So, because they tried to put on taxes and try to put America underneath the Bank of England, America rose against that. And that's why we are the country we are today. Now, since the beginning of our country, by 1782, Robert Morris was the superintendent of finance for America. At that time, he helped to open the Bank of North America in 1782 and has been accordingly called by Thomas Goddard the father of the system of credit and paper circulation in the United States. So as far back, all the way back to the beginning of our country, we are already trying to play these games with credit and paper. Now, as the ratification in early 1781, the Articles of Confederation had extended to Congress the sovereign power to generate its bills of credit. It passed later that year an ordinance to incorporate a privately subscribed national bank following the footsteps of the Bank of England. Now, why would we try to mimic and follow the footsteps of the Bank of England when the main reason we became America itself was because they were trying to put us under the rule of the Bank of England? Now, luckily, however, it was thwarted in fulfilling its intended role as a nationwide national bank due to the objections of alarming foreign influence and fictitious credit favoritism to foreigners and unfair policies against less corrupt state banks issuing their own notes, such that Pennsylvania's legislature repealed its charter to operate within the Commonwealth in 1785. So Pennsylvania chose to not be a part of the Commonwealth anymore because they were trying to put them under this bank. Now, about 10 years later, in 1791, former Morris aide and chief advocate for Northern mercantile interests, Alexander Hamilton, the Secretary of Treasury, accepted a compromise with Southern lawmakers to ensure the continuation of Morris's bank project. So we were already trying to have people put us directly back under what we just escaped, right? People came over here to get away from England and the British rule. And then we fight a war to break completely free of them. And now we have people already in the very beginning trying to put us back under that type of control. Hamilton agreed to ensure sufficient support to have national or federal capital move from its temporary northern location, New York, to a southern location on the Potomac. As a result, the first bank of the United States was from 1791. It had a 20-year charter to 1811, and it was chartered by Congress within the year and signed by George Washington soon after. Interesting. The first Bank of the United States was modeled after the Bank of England for reasons unknown, probably because it was just what they knew. But it differed in a lot of ways from today's type of central banks. For example, it was partly owned by foreigners who shared in its profits. Also, it was not solely responsible for the country's supply of banknotes. It was responsible for only 20% of the currency supply. The state banks accounted for the rest of the money. So you had the 20% of the notes in circulation were from this federal bank, and then the state would each also have its own type of currency. Now, several of the founding fathers bitterly opposed the bank, Thomas Jefferson being one of them. He saw it as an engine for speculation, kind of see what's going on right now, right? Financial manipulation, we could see that's happening, and corruption. In 1811, its 20-year charter expired and was not renewed by Congress. Absent federally chartered bank, the next several years witnessed a proliferation of federally issued treasury notes to create credit as the government struggled to finance the war. So 1811 happens. We get rid of a national bank because we don't want that. And what happens? A war. The War of 1812. What does that do? That puts strain on the economy. It puts strain on the government because they need money to fight a war. And they need a money printing machine to do so. So, a suspension of specie payment by most banks soon followed as well. So they were struggling to finance that war. Well, then when you have a struggle like that, that gives the people that are for things like that the opportunity to come in and say, hey, we need this because we're struggling. So after 5 years, the federal government charted its successor and went ahead and brought in the second Bank of the United States in 1816. Now that, again, was started for 20 years, which lasted till 1836. James Madison signed the charter with the intention of stopping runaway inflation that had plagued the country during the 5-year interim. Because you didn't have a central bank that could raise rates, lower rates, control all the rates, and let the market, do what it's naturally going to do. You didn't have a central bank to manipulate that and have a slow, steady inflation like we did for a long time, or correct itself and the money falls or gains value, actually. So because we didn't have a central bank, we let the markets do what they're supposed to do and price themselves. Well, they don't like that, because it makes really what it comes down to, it makes rich people lose a lot of money. But it also makes some people that, the average Joe trying to invest and make some money, he might be losing some money too. But the weird part about it is the average Joe that would throw the money into stocks or bank or whatnot, yeah, he'll lose some money, but he's going to keep on working and try to make more, right? It's those rich guys. They take a huge hit if they can't control the market. They want to be able to control it. They want to be able to get out when the times are good and about to fall, and they want to be able to get in when the fall hits the bottom. And if you don't have a central bank to control that and give you the tips of when to jump in and jump out, well, then that's problematic for you. So then you start becoming an advocate for something like this. Now, with branches across the country, Andrew Jackson, who became the president in 1829, denounced the bank as an engine of corruption. His destruction of the bank was a major political issue in the 1830s and shaped the second party system. As Democrats in the states opposed banks and Whigs supported them, he was unable to get the bank dissolved, but refused to renew its charter. Jackson attempted to counteract this by executive order requiring that all federal land payments to be made in gold or silver. So this is where we put the gold standard in accordance with his interpretation of the Constitution of the United States, which only gives the Congress the power to coin money, but not emit bills of credit. And that's why they didn't want to set a central bank. They didn't want to make the future pay for what they wanted now. Now, after that, there was a panic of 1837 that followed. The bank then flatly denied a subpoena to examine its records, and its chief, Nicholas Biddle, bemusedly observed that it would be ironic if he went to prison by the votes of the member of Congress because he wouldn't give up to their enemies' confidential letters. Despite congressional corruption, Biddle was eventually arrested and charged with fraud. The banker's charter expired in 1836. So, again, from the very beginning, second bank, already huge amounts of fraud. The guy had to be arrested for it, right? Probably for doing things they do now on a Tuesday. So you had a free banking area from 1837 to 1862. And here is a chart percentage change in money supply, and then they had a percentage change in price level. Okay, so yeah, during 1837 to 1862, we only had state chartered banks. They could issue banknotes against gold and silver coins, and the states heavily regulated their own reserve requirements. So each individual locale would have their own banknotes and would do banking within themselves, and they would keep a certain amount, and they would set their own requirements of how much they needed to keep. And I'm sure that would change depending on, what happened in that location. Such as, look at the Silicon Valley Bank, right? That is its own location in California, and because the Fed is raising these rates right now, that affected a bank way on the other side of the country and collapsed it, which is now starting a cascading effect throughout the banking system. And that is why they didn't want a central banking system. They wanted everything to be local, state ran, because the state can react to its own needs. Let's see. These banks had existed since 1781 in parallel with the banks of the United States. Again, that's because they were responsible for the rest of the money supply. 20% came from the Fed. The rest all came from state banks. So they all coincided along with the first and second Bank of America. Now, in 1837, the Michigan Act allowed the automatic chartering of banks that would fulfill its requirement without special consent of state legislature. So basically giving the banks autonomy. And how, I don't know why you would ever do something like that. Because when you put that, money is power, right? Or gets you power. And so if you have all the money, it's going to corrupt. The legislation made creating unstable banks easier by lowering state supervision in states that adopted it. The real value of a bank bill was often lower than its face value, and issuing banks' financial strength generally determined the size of the discount. By 1797, there were 24 chartered banks in the U.S., with the beginning of the free banking era in 1837, there were 712. So we went from 24 banks to 712. Nothing wrong with competition, right? Now, during the free banking era, the banks were short-lived compared to today's commercial banks. So they ran out of money. They failed. They didn't get bailed out. They just were gone. And they only had about an average lifespan of about 5 years. About half the banks failed, and about a third of which went out of business because they could not redeem their notes. Again, when you're handing your money over to someone else and you're expecting them to do the right thing, it's not always going to be the case. During the free banking era, some local banks took over functions of a central bank. In the New York Safety Fund provided deposit insurance for member banks. In Boston, Suffolk Bank guaranteed that banknotes would trade at near par level and acted as a private banknote kind of clearinghouse. Now, in 1863 to 1913, you had some national banks. The National Banking Act of 1863, besides providing loans in the Civil War effort of the Union, included provisions to create a system of national banks. They were to have higher reserves and business practices than state banks. Recent research indicates that state monopoly banks had the lowest long-run survival rates. The Office of Comptroller of Currency was created to supervise these banks. So we created a whole bunch of national banks. They would have their own region, and we created an Office of Comptroller that would be over them, are also known as the OCC. To create a uniform national currency. To achieve this, all national banks were required to accept each other's currencies at par value. So they all had a agreed value of what their notes would be worth. This eliminated the risk of loss in case of a bank default. The notes were printed by the comptroller of the currency to ensure uniform quality and prevent counterfeiting. To finance the war, national banks were required to secure their notes by holding treasury securities, enlarging the market, and raising its liquidity. As described by Gresham's law, which is a monetary principle stating that bad money drives out good. For example, if there are two forms of commodity money in circulation, which are accepted by law as having similar face value, the more valuable commodity will gradually disappear. As described by Gresham's law, soon bad money from state banks drove out the new and good money. The government imposed a 10% tax on state banks' bills, forcing most banks to convert to national banks. So they started forcing this, and you can kind of see what's happening, right? We create, hey, we're going to give you your own national banks, but they're going to, talk to each other, and then they start squeezing down, right? And they're going to accept your bank notes and all this and that, and then they squeezed those state banks out of there. By 1865, there were already 1,500 national banks. In 1870, 1,638 national banks stood against only 325 state banks. So they basically were running the state banks out of there. The tax led in the 1880s and 1890s to the creation and adoption of checking accounts. By the 1890s, 90% of the money supply was in checking accounts. State banking had made a comeback. Two problems still remained in the banking sector. The first was the requirement to back up the currency with treasuries. When the treasuries fluctuated in value, banks had to recall loans or borrow from other banks or clearinghouses. So basically, when the U.S. treasuries would fluctuate in the value, the banks would be losing money. So in order to get money back and get liquidity, they would have to call the loans in. And they could do that. Back then, they could do that anytime. They could recall the whole loan if they wanted to. The second problem was that the system created seasonal liquidity spikes. A rural bank had deposit accounts at a larger bank that it withdrew when it needed funds, or when the need for funds was at its highest. Like, for example, a more rural area in the planting season, they would need more liquidity because the farmers would need the money to go buy seed, fertilizer, all that stuff. So when combined liquidity demands were too big, the bank again had to find a lender as a last resort. So they'd have to go to a clearinghouse, go to the national bank, and get money. Now, these liquidity crises led to bank runs. So as soon as people found out the bank's out of money, well, hey, my money's in there. But was it really? No, it wasn't. It was sent off to the banks, to bigger banks. Kind of like what's happening now. So that was causing several disruptions and depressions. The worst which happened in the Panic of 1907. Now that directly led to what we now know as the Federal Reserve. And part of that was, the Panic of 1907 really was about a couple people's greed. They tried to corner a market. They didn't have enough people on board to corner the market. And basically what they tried to do is they tried to buy up all their own stocks and make all the short sellers basically try to short squeeze them. Problem was the short sellers were able to find more of those stocks elsewhere, and they shorted the crap out of that until the stock tanked. And because of that, that bank and other banks that were even like associated with it just crash. One of them was they call it the Knickerbocker crisis. But yeah, it caused the New York Stock Exchange to fall almost 50% from its peak value in the previous year. Now, national banks issued national banknotes as currency because they were uniformly backed by the U.S. government debt. They generally traded at comparable values, in contrast to the notes issued during the free banking era, in which notes from different banks could have significantly different values. So this would be pretty much kind of like trading currency between countries now. One thing people got to remember, each state in the United States is its own country. In fact, most people don't call countries in other parts of the world, they're states. But we are United States. So we're several countries united under one flag. Hope that makes sense. But a lot of people don't know that. Each state is its own country, and that's why state law is supposed to trump federal law. But oftentimes it doesn't, because the federal government can squeeze you out with the banks. Now, national banknotes were not ever lawful tender. So national banknotes you couldn't go use that to go buy your groceries and stuff like that. You had to use the state bank notes to do that. They could not be used as bank reserves under the National Bank Act either. So if a bank went and bought a bunch of national banknotes for whatever reason, they can't try to use that as what they say they have as reserves on the books. The federal government issued greenbacks, which fulfilled this role along with gold. Greenbacks. That started during Lincoln, I believe, if I'm remembering right. Now, Congress suspended the gold standard in 1861, early in the Civil War, and began issuing paper currency, the greenbacks. So, yes, during Lincoln. So, basically tried to get rid of the gold standard already right off the bat. Why? Because we didn't have enough gold to fund the war, right, between the North and South. We didn't have enough gold. So they started just issuing fiat currency at that time. The federally issued greenbacks were gradually supposed to be eliminated. So our money that we have now today, or cash anyway, was supposed to be eliminated in favor of national banknotes after I don't know how to say that word, specie, or it's supposed to say special. I don't know. Special Payment Resumption Act of 1875. However, the elimination of the greenbacks was suspended in 1878, and the notes remained in circulation for there on in after. So anytime they say they're going to bring something in for a short time, tax, whatever it is, it always stays. It never goes away. Federal debt throughout the period continued to be paid in gold, though. So even though they could issue this currency to kind of fund everything, when it came time for them to pay their actual debt, they did have to pay it in gold. In 1879, the United States had returned to the gold standard, and all currency could be redeemed in gold. So a lot of people don't know that. You used to be able to go take $1 into a bank and withdraw $1 worth of gold. And if you gave him $100, you get $100 worth of gold. However, that is no longer the case. And that all started, well, the downfall of that started in 1907. It caused to the actual creation of the Federal Reserve Bank, the panic of 1907, because the stock market was falling, fell hard, 50%. They had to do everything they could to try to stop it. Now, with not having no central bank to print money, prop up anything, they couldn't really do this. Now, each individual national bank could have did this, but probably couldn't agree on whether to do it or not at that time. And that's the problem with not having a central bank. You don't have one, it's like having the king versus having what we have. You have one person making all the decisions. You can blame it all on that person. But when you have 1,000 people involved, who do you blame it on? So early 1907, the New York Times Annual Financial Review published Paul Walberg's first official reform plan entitled A Plan for Modified Central Bank. So this was supposed to be something special, a new kind of central bank, in which he outlined remedies that he thought might avert panics. So early in 1907, Jacob Schiff and the chief executive officer of Kuhn, Loeb and Company, in a speech to the New York Chamber of Commerce, warned that unless we have a central bank with adequate control of credit resources, the country is going to undergo the most severe and far-reaching money panic in its history. The panic of 1907 hit full stride in October. Now, bankers felt the real problem was that the United States was the last major country without a central bank, which might provide stability and emergency credit in times of financial crisis. So basically, banks wanted to play with people's money. They wanted to, hand it all out and all that and not keep any on reserve. So they wanted something that could bail them out when they did a bunch of stupid stuff, just like we have today, right? So while segments of the financial community were worried about the power that had accrued to J.P. Morgan and other financiers. So in 1907, J.P. Morgan, under the guise of trying to be the hero, started propping up some of these banks, consolidating the banks, buying them up, getting them at their lowest point, and even given significant amounts to the actual New York State itself to try to keep the economy from crashing. But everybody knows when a very wealthy businessman starts offering money, that's going to be to his benefit, right? He's not going to do it to lose all of his money. He's not going to do it just to keep things from collapsing. He's going to get something out of it. So most were concerned about the frailty of a vast decentralized banking system that could not regulate itself without extraordinary intervention of one man. Yeah, so J.P. Morgan basically came in, propped a bunch of banks up, gave a bunch of banks money, gave New York State a bunch of money. I think he put something close to $30 million in of his own money, which back then, that's a lot of money. They didn't like the fact that this one man who had obviously done really well in the banking system, and I heard a long time ago that J.P. Morgan may have been the man to cause a lot of this, was whispering people's ears, hey, you should pull out your money, banks aren't doing good, stuff like that, cause a panic, bank run, and then comes in and buys the banks up for super cheap, consolidates it. Oh, what does that sound like? Oh, yeah, that's happening right now, isn't it? Yeah. So history's repeating itself about 112 years later, or 115 years later. Let's see. They stressed the need for elastic money supply. So they wanted a money supply that could stretch, bend. It's not going to break the system if things happen. They needed buffer zones, basically, that could expand or contract as it's needed. After the scare in 1907, the bankers demanded reform. The bankers, the ones that messed everything up, right? They demanded the reform. Hey, who's demanding reform in 2008? Oh yeah, it was the bankers that got bailed out, right? Unbelievable. So, Congress established a commission of experts to come up with a nonpartisan solution. The Aldrich Plan. Rhode Island Senator Nelson Aldrich, the Republican leader in the Senate, ran the commission personally with the aid of a team of economists. They went to Europe. They were impressed with how the central banks in Britain and Germany appeared to handle the stabilization of the overall economy and the promotion of international trade. So Aldrich's investigation led to his plan in 1912 to bring central banking to the United States, something that they fought against. Never let a crisis go to waste, right? With promises of financial stability, expanded international roles, controlled by impartial experts, and no political meddling in the finance, Aldrich asserted that a central bank had to be paradoxically decentralized somehow, or it would be attacked by local politicians, bankers, as had the first and second banks of the United States. So basically, they wanted the central bank to be completely autonomous and separate from any political meddling whatsoever. Yeah, that can never go wrong, right? The Aldrich Plan was introduced in the 62nd and 63rd Congresses, 1912 and 1913. It never gained much traction as Democrats in 1912 won control of both the House and the Senate, as well as the White House. A regional Federal Reserve System. So the new president, Woodrow Wilson, he became the principal mover for banking and currency reform in the 63rd Congress, working with the two chairs of the House and Senate banking and currency committees, Republican Carter Glass of Virginia and Senator Robert L. Owen of Oklahoma. It was Wilson who insisted that the regional Federal Reserve banks be controlled by a Central Federal Reserve Board appointed by the President with the advice and consent of the U.S. Senate. That sounds like a much better idea than giving free rein. Okay, agrarian demands partly met. So William Jennings Bryan, now Secretary of State, long-term enemy of Wall Street and still a power in the Democratic Party, threatened to destroy the bill. Wilson came up with a compromise plan that pleased bankers and Bryan alike. The Bryanites, as they were called, were happy that the Federal Reserve currency became liabilities of the government rather than of private banks. A symbolic change. And by provisions for federal loans to farmers. The Bryanite demand to prohibit interlocking directorates did not pass. Wilson convinced the anti-bank congressmen that because Federal Reserve notes were obligations of the government, the plan fits their demands. Wilson assured Southerners and Westerners that the system was decentralized into 12 districts and thus would weaken New York City's Wall Street influence and strengthen the hinterlands. I don't know what the hinterlands is. After much debate and many amendments, Congress passed the Federal Reserve Act, or also known as the Glass-Owen Act, as it was sometimes called at the time in 1913. President Wilson signed the act into law December 23rd, 1913. And this, my friends, is the start of the fall. So not even 200 years in, and we start the fall. Okay, let's continue. The Federal Reserve. Now, the Federal Reserve System, also known as the Federal Reserve, or simply as the Fed, is the central banking system of the United States today. The Federal Reserve's power developed slowly, in part due to an understanding at its creation that it was to function primarily as a reserve, a money creator of last resort to prevent the downward spiral of withdrawal and withholding of funds, which characterizes monetary panic. So the Federal Reserve is there as a reserve, as a last resort. Can you say that's the case today? We would have no new money without the Federal Reserve at all. Probably might be a good thing, keep the dollar high. At the outbreak of World War I, the Federal Reserve was better positioned than the United States Department of Treasury to issue war bonds, and so became the primary retailer for war bonds under the direction of the Treasury. After the war, the Federal Reserve, led by Paul Warburg and New York Governor Bank President Benjamin Strong, convinced Congress to modify its powers, giving it the ability to both create money, as the 1913 Act intended, and destroy money, as a central bank could. During the 1920s, the Federal Reserve experimented with a number of approaches, alternatively creating and then destroying money, which in the eyes of Milton Friedman helped create the late 1920s stock market bubble. So when they were creating the money, people were using that money, they were taking out loans, and they were dumping it into the stock market because the stock market was on the rise. Well, because people were taking loans out, getting free money, putting it on the stock market, they could get the money back after they sell it, get more money than what they put in, and pay the loan back. Well, everyone started doing that. It started driving prices wild, right? Created a bubble. Well, then that bubble popped because banks started saying, hey, we need that money. So everyone started to sell off, and that in turn caused the Great Depression. After Franklin D. Roosevelt took office in 1933, the Federal Reserve was subordinate to the executive branch, where it remained until 1951, when the Federal Reserve and the Treasury Department signed an accord granting the Federal Reserve full independence, like they were fighting against the whole entire time. We give them the full independence over monetary matters while leaving fiscal matters to the Treasury. So it was another major leap in the downfall. So the Federal Reserve's monetary powers did not dramatically change for the rest of the 20th century, but in the 1970s, it was specifically charged by Congress to effectively promote the goals of maximum employment, stable prices, and moderate long-term interest rates, as well as given regulatory responsibility over many consumer credit protection laws. Since the global financial crisis, central banks globally, including the Federal Reserve, have implemented several experimental, unconventional monetary policies in order to achieve their monetary objective. One of those being, I believe it was in 2021, they were taken off. I did not know this. They were taken off the fractional reserve standard. All banks were taken off the fractional reserve standard, which required them to keep 10% of the money in the bank of all their deposits. That way, if people needed access, they would have some liquidity to get people their money. Well, banks stopped doing that, and now you can see where this crisis, this banking collapse is starting, because they took everyone's deposits and dumped it into the stock market. They gambled with everyone's money, and they lost. Pretty much the same thing that happened in 1907. Well, my friends, that brings us back to the next leap forward in subverting your freedoms and our whole democratic process here. Federal Reserve's not beholden to any politicians whatsoever. They don't have to do anything the government asks them. They take suggestions and they try to fall in line with, what the current administration wants. However, if it's keeping the world economy stable, they're going to do whatever is necessary for the world economy. Don't have to have America's interest in mind. So that was a history on central banks. Just wanted to give you guys a quick rundown. Well, I guess it wasn't quick. I just wanted to give you guys a rundown because I think it's important to look back at history and see why people were against having a central bank in the first place, because that leads indirectly to what we're going to talk about. So that in mind, we're going to go ahead and switch over to another document. All right, we're going to go ahead and go to federalreserve.gov. And man, I could have swore this came out right around the time that they're trying to shove the whole, Trump's getting arrested and indicted, all this crap, just top of the news. I don't know how this isn't one of the most important stories in American history, because it's going to change everything. There's a March 15th press release of this year, 2023, and it announces a July launch for the FedNow Service. So, the Federal Reserve sets a lot of the monetary policies and a lot of the laws that govern what financial institutions can and can't do while serving the public for their debts and their credits. But what have they always wanted? One bank to rule them all, right? Before we get into this, one has to wonder why the feds kept raising the rates, banks begging them to stop doing it because it was straining the system, all the way up to the point where I believe it was somewhere in the neighborhood of, can't remember if it was 186 or 396 different banks are in huge jeopardy. I think it was 186. Banks are in huge jeopardy right now. Estimates are, by the end of all this, if it's done right and they want to avert a disaster, there will be maybe 6 major banks left. That's it. So what has the Fed always been good at doing? What have the bankers have always been good at doing is getting together during a global or financial crisis that a lot of times they create because someone's been telling people to pull their money out of these banks and they're causing bank runs. Well, then that gets the public starting to panic and they start pulling their money out, and then everybody starts pulling out their money out. Well, guess who comes to save the day every time, isn't it? The government. But in this case, it's not the government. It's a entity the government created and lost control of back in 1951, we just found out. So, March 15th, 2023, Federal Reserve announces in July launch for the FedNow Service. Now, the service will debut with financial institution and the U.S. Treasury on board. The Federal Reserve announced that the FedNow service will start operating in July and provided details on preparations for the launch. The first week of April, the Federal Reserve will begin formal certification of participants for launch of the service. Early adopters will complete a customer testing and certification program informed by feedback from the FedNow pilot program to prepare for sending live transactions through the system. So what is this? This is, you guys have all heard the conspiracy theorists say they want us to go to cashless society. They're gonna take control of the currency, and they're trying to go to a one world currency, right? Well, this is a step in the plate in that direction. This is the infrastructure that would allow that to happen. All the naysayers said, no, it can't happen. The infrastructure's not there. The government can't put that together. Here you go. The FedNow is a service. Now, it sounds like mainly right now, and this is how it's always going to start. It's going to be primarily for businesses and banks. But the certification encompasses a comprehensive testing curriculum and defined expectations for operational readiness and network experience. In June, the Federal Reserve and certified participants will conduct production validation activities to confirm readiness for the July launch. Okay, so quote here, we couldn't be more excited about the forthcoming FedNow launch, which will enable every participating financial institution, the smallest to the largest, and from all corners of the country, to offer modern instant payment solution, said Ken Montgomery, first Vice President of the Federal Reserve Bank of Boston and FedNow program executive. Of course, he's happy for his program. With the launch drawing near, we urge financial institutions and their industry partners to move full steam ahead with preparations to join the FedNow service. Wow. So many early adopters have declared their intent to begin using the service in July, including a diverse mix of financial institutions of all sizes, the largest processors, and the U.S. Treasury. In addition to preparing early adopters for July launch, the Federal Reserve continues to engage a range of financial institutions and service providers to complete the testing and certification program and implement the service through 2023 and beyond. Montgomery noted that availability of the service is just the beginning. Of course it is. And growing the network of participating financial institutions will be key to increasing the availability of instant payments for consumers and businesses across the country. So not only is this going to be for banks, it's going to be for consumers, it's going to be for businesses as well. Basically, the plan is everyone will be using this service. Everyone, whether you want to or not. The FedNow service will launch with a robust set of core clearing and settlement functionality and value-added features. Most features and enhancements will be added in future releases to continue supporting safety and resiliency. That's nothing the government has ever been a part of that has been successful. and innovation in the industry. I could say they're pretty boring as well. You can pretty much predict what they're going to do every time. In the industry, as FedNow network expands in the coming years. With the this is quote, with the FedNow Service, the Federal Reserve is creating a leading edge payments system that is resilient, adaptive, and accessible, said Tom Barkin, president of Federal Reserve Bank of Richmond, and now FedNow program executive sponsor. The launch reflects an important milestone in the journey to help financial institutions serve customer needs for instant payments to better support nearly every aspect of our economy. About the FedNow Service, the Federal Reserve banks are developing FedNow Service to facilitate nationwide reach of instant payment services by financial institutions, regardless of the size or geographic location, around the clock, every day of the year. Through financial institutions participating in the FedNow Service, businesses and individuals will be able to send and receive instant payments at any time of the day, and recipients will have full access to funds immediately, giving them greater flexibility to manage their money and make time-sensitive payments. Access will be provided through the Federal Reserve's FedLine network, which serves more than 10,000 financial institutions directly or through their agents. So, they announced this while they raised rates to a point of a catastrophic banking collapse. Then they announced this, basically going to be the saving bank for all the participants, hero to save the day. Hey, we can make transactions and everything immediate, instant. If you do your transactions through us, you won't have these missteps with, collecting money and paying off debts, things like that. And they want all the financial institutions that want to sign up. Well, as I told you, by the time this banking collapse in the economy kind of starts getting back to where it's going to start climbing its way out, it's estimated there will be about 6 banks left. That's pretty tight control on a small amount of banks that the FedNow serves. I mean, yeah, all 6 of those are going to be on board, and you could probably bet the bottom dollar that, pun intended, that they're going to be the ones that get bailed out during this banking crisis that's happening. They're going to be the ones that are going to get capital to stay afloat for this to come online. Let's go ahead and look at another page on the Fed's site from the Board of Governors of the Federal Reserve. Man, that sounds so totalitarian. Anyways, while the Federal Reserve has made no decisions on whether to pursue or implement a central bank digital currency, or CBDC, we have been exploring the potential benefits and risks of CBDCs from a variety of angles, including through technological research and experimentation. Our key focus is on whether and how CBDC could improve on an already safe and efficient domestic payment system. CBDC is generally defined as a digital liability of a central bank that is widely available to the general public. Today in the United States, the Federal Reserve notes, i.e. physical currency, are the only type of central bank money available to the general public. Well, I can't say that's true. Most of us, our money is digital already. It's on a card. We don't ever, a lot of times you don't even see cash. I hardly ever use it. I suggest we start using a lot more. But they go on to say, like existing forms of money, CBDC would enable the general public to make digital payments as a liability of the Federal Reserve. However, CBDC would be the safest digital asset available to the general public with no associated credit or liquidity risk. The Federal Reserve Board has issued a discussion paper that examines the pros and cons as part of its process, looking for feedback from the public on this. Now, I'm pretty certain that Biden signed an executive order. Let's see if we can find it real quick. All right. So, yeah, the executive order asked to explore U.S. CBDC, central bank digital currency, which is a digital form of the U.S. dollar. CBDC is a centralized cryptocurrency. Unlike other cryptocurrencies, the concept of centralized digital currency is not new. We constantly use domestic and international wire transfers, which is the ACHs and SWIFT. Thus, the main difference lies in the utilization of cryptography and the restrictive applications of blockchain technology. Many countries are studying and considering launching pilot versions of their CBDC. If the U.S. starts circulating the digital dollar, this can dramatically affect how money changes hands domestically and globally. Yes, it will. However, foreign exchange investors and users probably do not tell much difference except for smaller fees and more prompt money transfers, because most of the changes have to do with the back end. Whether CBDC will be more centralized than the current system, of course it is. The Fed is creating it. So, and whether CBDC will drive out private cryptocurrencies, which they will, are open questions and require further investigation. Yeah, so Biden basically wanted a framework and a cryptocurrency designed for to replace the dollar. I can't believe how these idiots just fall into this crap, especially to a bank that is not beholden to America. All right, a lot of this is just trying to explain programmable money. You can read it if you wish. It's FedNow, June 23rd of 2021. What is programmable money was the discussion. Now, a lot of this is just technical jargon and what is programmable money, what isn't, what they will consider to be programmable money, and what would be acceptable for a central type of digital currency. And they just go over the pros and cons of the two different systems. And right here, they're going over coherence guarantees. And for programmable money, they're saying maybe we can create a system on someone who's already had a blockchain or type of system like that, and then we'll just guarantee that money. So if for some reason the transactions aren't instantaneous due to something with a business, the Federal Reserve will still guarantee that money. But now, for them to guarantee that money, you'll have to keep the relationship good. All right, everyone. So I wanted to go down to this paragraph here because this kind of more sums up kind of my thinking on the whole U.S. CBDC type of currency, and sums up how other people feel about it too. So this is part of the discussion. I scrolled down here. So it goes off: a more theoretical example of programmable money is a hypothetical programmable digital currency offered by a public sector entity already issuing other forms of money, i.e. the central bank. Now, central banks of sufficient reputation and credible technical capability to offer programmable money system, which now you could say the FedNow Service is that credible technical capability, may be able to offer coherence guarantee primarily on the basis of the reputations alone. So, I mean, that's why our money is worth anything, is because of their reputation, to, pay the U.S. debt and everything like that. That is why our money's worth anything of what it is right now. So it basically is debt owed to the Fed Reserve, but it's guaranteed on their reputation. So with an implied incentive for maintaining those reputations. So now that is a very interesting quote there too. So they have to maintain their reputations with, other central banks and banks. And so if, most of the banks in the world that don't think like America says, we don't like the fact that this money is used in this way, well, they have to put forth regulations, things like that, to be able to continue to operate in the central banking world. Or if it happens to be just a bank, period, they have to apply to those rules apply to them as well. And if the businesses are directly tied to this type of thing, they have to subscribe to those same rules. And they have an incentive to do so, because then that means, their account can't be used. If their account can't be used or accessed, well, so it basically holding the money hostage. This approach is not open to most would-be providers of programmable money systems, and that's exactly why they don't want, some entity that has a large amount of pull, i.e. the International Monetary Fund, one of the biggest banking settlement systems in the world. They basically settle all the debts and everything for the central banks around the world, and also allows transactions between countries. So it says the approach is not open to most would-be providers of programmable money systems, but it may be the case that the same authority that allows certain governments to issue widely used fiat money with its guaranteed of continued value in the future, enabling its use today. So future debt, future money, debt now. So we use the debt. It's a debt system. So the money is a debt to be paid in the future. We're banking on the value of the future. It will also allow those entities to issue programmable money by fiat. So that means they can just print however much they want or need because of future value. That now they'll have to stay within their range of projected value, otherwise their currency becomes devalued, such as our American dollar has. Although no central bank has yet offered such a programmable digital currency product, it remains possible development of general interest in central bank issued digital currencies still persists. Now, remember, this was about a year and a half ago, in January or June 23rd, 2021. And there's actually a lot of central banks trying to look into this, creating a digital currency. Now, in here in the final note on guarantees, the word guarantee in the preceding discussion should always be read with implied quotation marks. So you have to quote the word guarantee around it. Public cryptocurrency systems like Bitcoin have worked in practice for years, but the behavior of validators in the long run, when the incentive structure no longer includes subsidies in the form of block rewards remains an open question, and external factors leading to a loss of confidence in such systems could also affect the guarantee. As illustrated in the practical example of privately offered programmable money, such systems may vanish if the offer decides to discontinue them. So they're basically saying you could have your money in cryptocurrency, and then the person who offers that cryptocurrency, say like Dogecoin, they just shut down and it's just no longer there, and they took all your money. So that is what they're saying there. Technological capability regardless. Central banks could similarly issue, and this is the concerning part right here. So central banks could similarly issue and later elect to demonetize a digital currency, attempting to assess the comparative strength of various coherence guarantees in these situations and others is beyond the scope of this note. Basically, they're saying if they create one of these and they're printing as much as they want to have, of what would happen if China created their own digital currency and we're trading back and forth with them with the amount of trade we do, and they decide to devalue their own currency, right, as a sanction against us for, I don't know, let's say defending Taiwan or something like that. And how, I mean, it's no different than the exchange rates right now between, US dollar and the ruble or the yuan. So same thing, just can happen more instantaneous and with a few strokes of the keys. Potentially more important than any such hypothetical framework, however, is the credibility of the guarantee for any programmable money and product in the eyes of the potential users. Observing user attitudes toward pre-existing services like payment APIs and new offerings such as open banking APIs and cryptocurrencies may offer insight into this evolving landscape in the coming years. I'll tell you what really concerns me is, let's say Congress can't agree on, let's say, gun laws, right? We can't agree. And we all know that we don't agree on it. The two different sides can't come together and just, stop continuing to infringe on that Second Amendment right? They got to just keep progressively going, because the right wants everyone to have guns. The left wants no one to have guns. I don't understand why there can't be a middle on this, but it's ridiculous because the left keeps marching forward. There's enough gun laws out there, right? Criminals can't go buy guns if they have domestic violence charges, violence against another person, violence against themselves, their family. You cannot go buy a gun. You're put on a list. In fact, my brother had this happen to him. Even though found not guilty and everything, he still wasn't able to get his rights back because of one of those laws. So he has to go through a bunch of crap to do so. But that's out there, right? There's also gun laws to keep criminals from buying guns. You cannot be a felon and own a firearm. In fact, a firearm can't even be within your vicinity, and any firearm with a bullet in the chamber gets you a certain amount of years, and every bullet in and around that person is 5 years. So this whole thing with criminals getting their hands on guns, it's not criminals getting their hands on guns. And we've all seen in most cases, the police are selling those guns to them. You got one crooked cop in there, they confiscate all these weapons, and it doesn't make it to evidence, and they go ahead and sell it off or whatnot to criminals. But let's say, sorry for the tangent there, let's say, for the sake of everything, we can't agree on this. Well, then whatever president that's in there issue an executive order to the Fed and say, hey, it's fine, they can keep their guns or whatnot, but they can't have this bank account, which you're pretty much going to be forced into, right? You're going to be forced to use this FedNow service, and it's probably going to be some type of token that comes out that replaces cash. And they say, yeah, you can go ahead and have your guns, but because you have that gun, you can't have one of those accounts. Well, you can't use any other kind of money. They're not accepting cash. You can't go pay in gold. I mean, no one takes gold for transactions. That's the one thing I don't understand about everybody selling and trying to buy gold and silver and things like that. Yeah, it's cool to have or whatever, but where can you actually go to do anything with that? Nowhere. I mean, if it all really came down to it and the society broke down and all that, you think gold is what people want? I don't think so. I think it's going to be food, guns, ammo, gasoline, while cars can run and gas, is still good. Cars, be a good form of currency. Labor. But gold, I mean, what are they going to do with that? I don't think we're ever going to go to a gold bartering system because, for one, who's going to put what the gold? I mean, if you had a situation like that, who's going to put what gold's even worth, right? Who's going to decide that? The person that's accepting it, I guess, but that would vary from one person to another. And if you need food, you need gas, you need shelter, whatever it is, I just don't think gold's the way to go. But if you guys disagree, go ahead and put it down in the comments. If you want me to talk about what I think would be good for currency and situations like that, go ahead and drop a comment down there. But that is my concern. My concern is when they talk about programmable money, that means, they could put into that script, you go try to buy a gun from someone, or let's say they say, there's too many cow farts and it's causing global warming. You have to cut down your carbon footprint, and each, package of meat costs so much in carbon, right? Well, that first steak that you buy, it was like 10, 12 bucks or whatever of those tokens. And, but then you go to buy another one that week, and they say, oh, whoa, you've already had your red meat for this week. We're going to have to charge you an extra tax on that. It's going to cost you 20 now, because now you're contributing to more carbon, right? So now they can program that into that. He already bought one, here's another. And we're going to have to charge him more for that, because we already know through the script and blockchain that he already had purchased some meat. So every item can be programmed into that currency, and you go to buy that item. If they feel like you're having too much of that, or let's say like they did in some cities where they started putting extra tax on sugar drinks and stuff like that, and outlawed big gulps, telling you what you can and can't put in your body, while they allow acid to be put and diluted into your water. It's amazing. So, and then even talking about stuff like this, now we can implement a social credit score, right? We can say, hey, he's only allowed to use this much of his income because he spends too much, or he said this, or she said that, right? He's speaking out against the government, cut it off. Done. So going away from a cashless society, this is something that we really, really need to talk about. I think I'm going to be focusing on this pretty hard, because we don't want that. We don't want that at all. So let's go ahead and go over to this article produced by Business Wire, which is a Berkshire Hathaway company. So somebody who's in the know of what's going on in the banking sector. This came out on March 22nd, 2023, and says the Tasset Group, Inc., the leading provider of a private blockchain-based business-to-business real-time payments, and financial services solutions to banks today announced its client-facing API can serve as an on-ramp to FedNow, the Federal Reserve's forthcoming real-time payments rail. So, kind of interesting. They are comparing this to a railway system. We've all known how that's gone lately. With the introduction of FedNow, the Federal Reserve will make its first national update since the 1970s, bringing real-time payments to the financial sector around the clock. TASET's current offerings, TASET Pay and the Digital Internet Bank Network, are end-to-end private blockchain-based solutions that can serve as on-ramps to FedNow for commercial banks seeking to participate in the Fed's platform. TASET already offers FedWire connectivity to all of its banking partners and is a FedNow Service Provider showcase participant. Everyday consumers are able to move money at any time of the day and at any point of the week, yet businesses are limited to a 9 to 5 p.m. Monday through Friday. That needs to change, and we are excited for the arrival of FedNow, said Kevin Green, chairman and CEO of TASET Group, or AssHat Group, or whatever you want to call them. At TASET, our mission is to empower banks to serve their clients with increased speed, security, efficiency, and FedNow will be a great complement to their offerings. Bet it will, because more than likely in the end, the FedNow is going to be their only offering. Since its founding, TASET has played a crucial role in addressing commercial banks' need for secure instantaneous payments 24/7, 365. TASET Pay, the company's flagship product and the leading provider in real-time digital payments for commercial banking clients, recently announced a milestone exceeding $1 trillion in transactions since only 2019. In February alone, TASET Pay processed over $130 billion in transactions, underscoring the volume at which TASET bank partners are leveraging the program. That is interesting. That's a lot of money in 1 month, especially in a month where, in most cases, you're having slightly down type market. It's usually slow for businesses and everything during that time. So that's interesting. Unveiling a real-time service on a national level, FedNow will create additional use cases for TASET banking partners. To date, these include Western Alliance Bank, Customer Bank, Axos Bank, Byline Bank, and Cogent Bank. With its bank partners, TASET has developed more than 20 use cases, including logistics, mortgage, warehousing, commercial construction, private equity capital calls, as well as broader working capital applications for a bank's corporate clients. So even the corporate clients are able to use this service. And I'm assuming here pretty soon it'll be individuals as well. The results have created strong corporate banking relationships, increased deposits, and opportunity to provide other profitable financial services. Let's see about the TASET Group. Let's get a little information on them. TASET Group Inc. is a New York-based technology company that is the leading provider of a private blockchain-based real-time solutions for commercial banks, including TASET Pay, which enables banks to provide their corporate clients with instantaneous, secure, real-time payments 24/7, 365. TASET Pay has become the most trusted blockchain-based platform for the banking industry and its B2B clients, with more than $1 trillion in secure, real-time transactions to date. TASET smart contracts and FedWire functionality make TASET Pay a one-stop shop for B2B payments. TASAT was honored with 2021 Google Cloud Customer Award for Innovation in Financial Services, and then it goes on to give you their contact information. So that's pretty interesting, really interesting, that this was the group that the FedNow just went ahead and signed on to. Makes you wonder if they were already being funded by the Fed. All right, guys, I think I'm going to have to wrap the video up here. I know it's already gotten long enough. I got some really good videos that I want to share with you and discuss, that kind of puts everything that I said today into perspective. These are people that have been in the financial business system, or have participated in even, like, the largest monetary hedge funds that are in the world. People are really, really worried about this type of system, and also finding it very suspicious that it's all coming out at the time when the banks are collapsing due to the Federal Reserve's policies. They are directly tied to their policies and what they are doing, and the Fed has pushed it to a point. Same thing about in 2008, pushed it to a point where they all start to fail, and then they come in and buy those banks up, and they have the larger banks kind of suck up all these banks. They keep letting them be created for now, and then they create this situation where the bigger banks that have been around forever, like JP Morgan, can come in and swoop them back up, take all their assets. They let them put up the money for the infrastructure, or they took out a loan with them and let them build the infrastructure, let them do all that, and then we just come in and swoop it up once we demolish the system. And they've done it time and time again, and JP Morgan's usually directly tied with a lot of these things. It's kind of crazy, all the way back to the very first panic of 1907. So I'm going to go ahead and wrap it up here. I hope you guys enjoyed the video. Please get this out there, share it with people. If you want to hear more on this topic, go ahead and subscribe. I plan on really hitting this one hard, because this is the start of the train starting to get to rolling on the tracks. And there is still hope to dismantle these tracks before they can even get started. And I hope that we can sit down and have a good discussion between both sides, the right and the left, because this is not a right or left thing. This is a human thing, and especially something that could be in direct violation of American standards of living and culture and our freedoms. And we can't let that happen. It's going to take a lot to wake people up out of their dream state and get them to see reality for what it is. Get them to see the code. What it's going to take is all you got.